You know, I've been staring at the gold chart for 20 minutes this morning, and for a moment, I almost convinced myself nothing was happening. Price is pinned just above $4,616, barely moving, the 5-, 10, and 20-period moving averages compressed into a $3 band. It's quiet. But I've been doing this for 15 years, and that kind of quiet is the loudest alarm I know. It's the silence you hear right before a fault line snaps. I am Eric FRO Alpha Market Meridian. Right now, gold is trapped between two gargantuan forces that have never been this close in history. On one side, the paper market is in full retreat. Global gold ETFs just hemorrhaged $12 billion in March, the single largest monthly outflow ever recorded. On the other side, central banks bought 244 tons of physical gold in the first quarter. That's the seventh heaviest quarterly purchase in the modern record. You have institutional paper selling at one end, and sovereign physical accumulation at the other. And the price is squeezed exactly between them, coiling, building energy for a break that will decide portfolios for the rest of this quarter. And I'm going to tell you exactly how I'm positioning for that break. But first you need to understand the one number that matters above everything else this week, $4,644. That is the level where the daily chart changed character. It was support. It became resistance. And until gold can reclaim it on a daily closing basis, the structural story is bearish. Every rally is a sell. Every bounce is a potential liquidity grab. That's not an opinion, it's what the chart is screaming at anyone willing to listen. Let me walk you through what I'm seeing, because once you see it, you won't be able to unsee it. Open your 60-minute chart. Price is sitting at $4,616, underneath a descending ceiling of moving averages. The MA50 is at $4,622. The MA80 is at $4,628. The MA100 is at $4,624. All three are sloping lower, like a series of layered lids pressing down. On the daily chart, the MA60 is way up at $4,748, miles above current price. The MA200 sits around $4,604, and price has been flirting with it, drawn down by gravity. This is a textbook bearish alignment. The MACD on the daily is deep in negative territory. Histogram bars expanding to the downside. There is no divergence, no hidden bullish signal yet. Momentum is accelerating in one direction, down. The key structure is this. Last week's drop from $4,730 to $4,509 created a clear breakdown. The pivot point, the axis of that move, is $4,644. Below it, bears are in control. Above it, the bearish logic cracks. So the trade is simple in concept but brutal in execution. You sell rallies into $4,640 to $4,644, and you stay cautious about buying dips unless you get a capitulation spike that washes out everyone. I'll give you both setups, but first, why is gold struggling? Buyer's dream. Except something has changed. In this cycle, when Iran fears spike, oil jumps, inflation expectations rise, bond yields climb, and suddenly gold, which pays no yield, becomes less attractive. The safe haven bid is being cannibalized by the rates channel. That's exactly why we saw gold fall 1.2% on an escalation headline in late April. The old playbook isn't working. The new playbook says, in this environment, geopolitical risk can be gold negative. Add to that the Federal Reserve. Last week, Powell's tone was hawkish. Rate cuts in 2026 are vanishing from the dot plot, and core PCE is still stuck at 3.5%. Real yields are rising, the dollar is steady, and that means institutional portfolio managers are rebalancing out of gold. That's the $12 billion ETF outflow story. It's paper gold being dumped on a scale we've never seen. But then, every time spot dips towards $4,560, $4,550, $4,510, there's a hand catching it. That hand is the central banks, China, Poland, the Czech Republic, Uzbekistan, buying physical bars, accelerating de-dollarization. Goldman Sachs sees that and keeps a $5,400 year-end target. JPMorgan lifted theirs to $6,300, calling gold their highest conviction long. So you are literally watching a war between the paper market and the physical market. And the battlefield is $4,644 this week. The ISM services number on Tuesday could jolt rates expectations. But the real binary event is Friday's non-farm payrolls. Hawkish Fed narrative. And gold could get slammed through $4,500. A weak print opens the door for a short squeeze that recaptures $4,700. Friday is the catalyst that will resolve this range. Until then, we trade the range with a bearish tilt. So let's get to the setups. I'm going to give you 3 trade plans, and I want you to write down the numbers because they are precise enough to run on any platform. The first strategy is the conservative fade. You are selling a rally from the top of the range. Entry zone is $4,635 to $4,642. You don't just jump in, you wait for a bearish engulfing candle or a long upper wick on the 15-minute chart, and the 15-minute RSI must be above 55 and rolling down. When you get that double confirmation, you sell. Your stop loss goes at $4,652. Exactly $10 above the resistance zone and above the all-important $4,644 level. If gold breaks above $4,652, the bearish structure is compromised and you're out. That's a risk of 10 to 17 pips. Your first target is $4,598, which is the middle of the current range. That's 37 to 44 pips, giving you a solid 1:3 risk-reward. When that first target hits, drag your stop to break even. The second target is $4,562, the bottom of last week's support zone. That's 73 to 80 pips. This trade only fails if gold closes above $4,644 on the hourly chart without printing the rejection signal. The second wick, a body close. That confirms the range support has shattered. Entry is on that break. Stop loss at $4,614, right above the short-term moving average cluster. If price breaks down and then rockets back above the Mars, it means you got faked out by a liquidity sweep. Take the 28 pip loss and move on. Your first target is $4,530, the weekly support floor, 56 pips away. Second target is $4,510, the low of last week's capitulation, 76 pips. Third target is $4,495, a structural objective if NFP pours fuel on the fire, 91 pips. With a 28 pip stop and a 76 pip target, you're running a risk-reward of 1 minute and 2.7 seconds. Trail your stop to $4,590 after TP1, then to $4,540 after TP2. The third strategy is the aggressive knife catch, for professionals only. You step in and buy a panic spike into $4,505 to $4,515. You need a rapid, fear-driven candle with a massive lower wick on the 5 or 15-minute chart, immediately swallowed by a bullish engulfing candle. You're betting that the central bank dip buyers will absorb the selling at these levels. Stop loss goes at $4,493, a painfully tight 12 to 22 pips. If $4,500 doesn't hold, the floor is gone and you must be out in an instant. First target is $4,504 unit. Before you place a single trade, do the math. 1% of your account, no more. If you have a $10,000 account, your maximum loss is $200. On the standard 28 pip stop, one standard lot is $10 per pip, so 28 pips is $280, too high. You scale back to 0.7 lots. Run that calculation every single time. And for heaven's sake, do not hold any position into Friday's NFP release unless you've reduced size to a level where a 500 pip adverse gapping move won't erase your account. Stops are not guaranteed during news chaos. Close out 15 minutes before, reload after the first candle settles and liquidity returns. So here's the narrative I'm carrying into the week. Below $4,644, I am a seller on rallies. I respect the range support at $4,586, but if it breaks, I'm targeting $4,530 and $4,510. I acknowledge the massive structural central bank bid underneath us, and I'll only flip to a buying bias if I either see a daily close above $4,644 or a pure capitulation spike with proven absorption below $4,515. Friday's NFP is the key that unlocks everything. A hot number sends gold towards $4,400. A weak number sends it back towards $4,744. My plan is built for both. Now I want you to pull up your own chart. Where do you draw your line? Clarity on the gold battlefield. Smash that like button. It pushes this analysis to more traders who need to see it. Subscribe and ring the bell. I post 8 asset breakdowns every single day. Australian dollar to US dollar to Japanese yen, Nike 225, gold, WTI crude oil, Bitcoin, euro to US dollar, and pound sterling to US dollar. Every time zone, every major move. Don't get caught offside, trade smart. Trade safe. I'll see you in the next one.